Welcome to Baldwin Shareholders Presentation. This is our business plan for 2020, and we're going to start reviewing our mission statement. Our mission statement it is to deliver the fastest, most efficient sensor on the market to the highest number of customers. We have an special announcement because this year we have been recognized by the Better Business Bureau for being one of the most reliable elevator sensor suppliers to our industry and for having the best-selling product in the high-tech market. For our business analysis, we answered the question, how well do we live up to our mission statement? We graded ourselves 8 out of 10. The reason we did this is because we have been improving year over year, driving an outstanding performance in both of our market segments. Sales and profit have been increasing, and we have been investing on automation and 2KM processes. We're looking forward to responsibly produce using our technology advantages offered in the market. Okay, so now let us review some details about what the reason we graded 8 out of 10, and that will be covered by Zach.
The reason why we weren't able to give ourselves a full 10 out of 10 were just a few critical incidents that pulled us back from peak performance. One of them happened in round 5. We had a pricing and forecasting issue, which caused the loss of market share of about 700 to one of our competitors. They undercut us on pricing, and we weren't able to compete very well in that round. And then after that round, we were unable to recover that market share. Round 7, the biggest thing that happened in round 7 was it's just a simple quote. We let Bang drift. Bang is one of our highest producing high tech products that we let drift a little bit too far away from the perfect positioning, and it was just a sad day. And the quote of the round was that was just our mistake. There's not a lot we could do about it. We ended up losing profits and market share because of that. Round 8 we had another incident where we lowered the capacity for a low tech product, Baker. Our plan was to really kind of let it phase out. It was a bad idea just because we stocked out of that product and we lost out on a lot of profits and revenues that we could have gained there.
Now we're going to cover our competition. For the high tech, we're very on the edge of it. We were the high market for the high tech. We sold over 1,100 units of our Buster product, and our competitors were around the 900 units the most. We can see we all have a pretty much similar percentage on sales, and our closest competitor was AMP. For the low tech, it was not our focus on this year, the low tech. We have a 13% of the market share out of 100%. Our biggest competitor was Able. It has the most sales, and Zach and Jonathan will cover some details about what were our plans on the high tech and low tech segments for the coming year. But first, let's talk about our winning product. Now our winning product, it is Buster. The reason why we qualify Buster as our winning product is because it is a AAA product. It has been the best in the market. It was the best in the marketplace and in the high tech. We also sold a lot of units on the low and the low tech. So we're just so well forecasted, and it will have such an amazing performance that the product was able to sell out in both of the market segments. So that's the reason why we qualify Buster as our winning product.
So we want to go over our 2028 sales report. You guys have probably already received these notes in your report. So let's just start off with the elephant in the room. I'm sure as you guys reviewed your report there, you noticed that, well, what the crap happened in 2028? Zach talked about this a little bit. So, Sonia also mentioned the product Buster. So you see Buster right in the middle there. He's taken up some low tech and some high tech. That worked out really well. And we thought, hey, maybe let's let Bang drift a little bit out of that group and see how he does if he's not mixed in that high tech group. That didn't work out too well. So by missing out on the sales from Bang, obviously our sales dropped for 2028, which is not what we wanted. But we'll be repositioning Bang next year, and we should be able to recoup that. So we'll move on to the next slide here. So a little bit of our financial snapshot. Obviously, the sales report you can see there. We'll click. We got some stats. They'll pop. Oh, that dang elephant keeps following us around. So I populated the last 4 years for everybody, so you can take a peek on how our growth has been compared to this year, and what our 2029 projections are. So starting in 2025, you can see our sales there steadily increasing other than this year, but we forecast with the repositioning of Bang next year to be in the 142 million range next year. Percent of growth, for example, 2025 percent of growth was 11.99. That would have been over the previous year, 2024. So every year has been steadily increasing growth-wise, obviously, except for this last year. But we calculate that we'll be back to about 11.5% increased in 2029. You can see our EBITDA profits there steadily increasing, even with the low sales volume this year, 2028. Our earnings were still up, as were our return on sales. You can see that was our highest year ever at 13.5. We project to be around 13.3 next year. Our ROA stayed pretty high this year as well. We'd like to have that around 18.2 next year. Return on equity, again, we'd like to have that around 27% next year. It dropped to about 22% last year. Our highest year was 2026, where we were at 29.6. You can see our asset turnover there. Our goal is to be at 1.35 this upcoming year. If you look at our market share, 2025, we were at 19.8. We grew that to 23.96, almost 24% there in 2027. We lost a little bit last year, but we'd like to regain that again next year. Our calculations show us being at about 23.5 market share next year. And you can see our stock price also was able to climb every single year. Even with a bad year last year, our stock price still stayed pretty steady. So that's kind of our financial snapshot for the year. You can see up above there our stock price, just compared to some of the other companies in the marketplace. Actually doing pretty well as far as the stocks go compared to the others. Okay. Production and capacity. So we wanted to show you guys a little bit of where we're at right now with our production and capacity. We have 4 products in the market right now: Baker, Bang, Buster, and Brinks. You'll see the first column there, that's units sold. Obviously Bang didn't do too well, but we've already talked about that. But if you add all those units together, we sold 3,389 units. I know that elephant's not going to leave me alone today. So we sold 3,389, and then if we look at our dual shift capacity, we have the capacity to produce 5,300 units. So our capacity is quite a bit above what we're selling right now. If you want to click that next one, Zach. So we've got our projected capacity needs, just to let you guys see what we're looking for in the next few years. We've projected out 4 years. Our low-tech demand this year was about 9,200 units, and they've been growing at about 10% a year. So if we fast forward 4 years, that puts them at about 13,000 units. If you look at the high-tech demand, this year the high-tech demand was just over 8,000 units, but they've been growing at just over 20% a year. So 4 years out, that would put them at 17,000 units. So based on our current market share, which we do plan on growing, but just on the current market share, 4 years out, we would need capacity for approximately 6,500 units, which will not be a problem at all. We've been growing capacity every year. You can see we already have 53 units available to us this year in capacity, and we'll continue to grow that each year as we go to meet the demands that will be coming on the market. We can pop to the next. Okay, so financial needs. Well, we're not exactly rolling in cash, but we're doing okay. Just a few highlights here for you. Our cash position is just over 16 million right now. We have about 8.5 million in accounts receivable and 22 million in inventory. So our current assets are sitting right now at 46.7 million. Our accounts payable is the only current liability. We have no current debt right now. That's at about 5.4 million. And just a little highlight there that you're not going to see on this report, but if you look back on the year's report, you will see that we retired about $14.5 million worth of long-term debt this year, which has dropped our long-term debt down to about 12 million. So total liabilities right now are 17.8 million. So obviously we're in a great cash position right now. I don't anticipate that we'll need any financing or funding for the next year or two. We may have some rapid expansion with another product or two that we may have coming up in the previous years, but for right now, I don't think we'll need any other financing.
Going forward, aside from financing in our current position, we're going to go over what our strategy was segment wise. For the past couple of years, we created a dual segment product that did us very well. While the high tech and low tech segments, they had a little bit of overlap, so we were able to grab some market share from both of those. We realized that in the future that will not be the case. Just the fact of the rapid growing high tech market is pulling away from the low tech market. We decreased capacity on the low tech products, which we realize now that was not the best idea, just because the low tech products, they are selling well and they are a sure source of revenue that we can usually depend on. We normally maintain between 3 and 4 products in optimal position for the past couple of years, 2 in high tech, 2 in low tech. The reason we did that just to kind of span the market as much as possible. We did focus a little bit more on high tech products. We had a low tech, a mid tech, and then 2 high tech for the majority of the time these last couple of years. That's what our strategies have been. What we would like to do going forward would be more definitive in our specific market placement by positioning and buyer criteria. We want to take advantage of the rapid growing high tech market. It is growing at almost twice the rate of the low tech. So we want to grab as much market share of that as possible. While doing that, we want to use the profits from the low tech market, from the low tech products, to fund research and development for the high tech products. Just because they have high contribution margins, they're easy to take care of and easy to maintain. We do want to increase our market share incrementally of our high tech market. We want our target market share is 27% after 4 years, and after 8 years, looking out quite a ways, we want 29%. Basically, increasing our market share by 0.5% per year over year. While doing that, we want to maintain a 16% market share of the low tech. It is a slower growing market, so we do want to keep our fingers there, grabbing those profits that will fund our research and development for the newer products, for the newer high tech products. With that, with investing in the higher tech, we're looking at a lot of market frontiers. So let's take a look at low tech real quick. The market growth is about 10%. High tech is about 20%. Like I said, it's about high tech. The growth is about twice as much. Our current company share for low tech is kind of right where we want to be, 16.6%. And our share projection is going to be about 16% in 4 years. We're going to try and maintain that as best as possible. Our current company share for high tech, for total market share for high tech, is about 23. We've been up to as high as about 25, and our share projection is in 4 years. We want to incrementally arrive at 27. So in 8 years, we can have about 29% of a large market. The percent of total industry demand for low tech right now is 53%, so it's a little over half, and high tech's a little under half. It's not going to stay that way for very long. As we can see, out 4 years, they actually switch places. The low tech drops down to about 46% of total industry demand, and the high tech goes up to about 53.7%. Diving a little bit deeper into this, the things we want to focus on with the low tech is their high contribution margins. They're very easy to maintain, low operating and maintenance costs. It's a settled, lower competition marketplace, so we can always have a pretty decent market share, have a dependable revenue year over year for the low tech. The reason that we want to invest more in the high tech is the more profit opportunity, because the rapid growing market, we want to increase our automation there so we can produce more and more and more, and increase our capacity as well. With this, the market exploration, creating newer high-tech products, and research and development will help with that. Exploring a little bit more why we want to go into the high tech, just showing kind of numbers wise. We want to follow the slow progressive shift of the marketplace. So out 4 years, we can see that they basically switch places, the high tech and the low tech. But looking out even further than that, low tech goes down to 37.2%, and the high tech goes up to about 62.8%. And the total market, the total industry demand of the high tech ends up being about twice as much of the low tech. So we want to be a part of that. We want to be a part of that fast growing market. What I did put it on the end there is, if we were to keep an easy 25% company market share of that, we'd be sitting at a pretty good place, grabbing lots of profit. But I do want to show what our plans to maximize that market share as much as possible. Going back to, if we were to keep it 25, our increase in revenue out 4 years, it would be about 377% increase in revenue for 8 years if we were to stay at about 25%. But what our plan is, and what our basically our dream and what our goal is increase by 0.5% year over year, and out 8 years we actually be almost 60% more increase in revenue with a larger marketplace. And as we can see, our revenues from that will be substantially larger, and that's basically what we are wanting to do. We don't want to stay average, we want to have that growth. So basically what our goal is to capture market share of the rapid growing high-tech market. That's our vision. Thank you for joining us. Thank you for listening to our presentation. We hope that we were able to portray our vision of maximizing profits and grabbing market share with market exploration and high-tech product exploration. Thank you.